To talk more about the impact of the Federal Reserve's decision, I'm joined by Michael Collins. He's the CEO of WinCap Financial and an adjunct professor at Endicott College. Thanks so much for joining us on the program tonight. Now, talk through some of the factors behind keeping these rates unchanged.
Yeah, so this was really on path what the Fed had planned. The big surprise was that they said even with the impact of potential tariffs, that they're still on track for 2 cuts this year of about 50 basis points.
Right. It's interesting, though, in the post-meeting, the FOMC noted an elevated level of ambiguity surrounding this current climate. What will it mean for the economy overall, do you think?
Yeah, well, the ambiguity is really coming from lessened GDP expectations, potentially higher business inflation as defined by PCE inflation. But on the other side, unemployment is still at a very healthy level. But there's a lot of uncertainty, and uncertainty could become a self-fulfilling prophecy when it comes to business spending.
And Powell also said that inflation expectations have recently moved up with tariffs as that driving factor that you mentioned. How much are politics driving today's revelations?
Yeah, that is going to be harder to tell what's happening behind the scenes. But, mortgage rates are still very high. Trump has done a decent job with some of his rhetoric, talking down the dollar and the level of long-term interest rates since the start of the year. Some may think that's by design.
Right, okay. And, you mentioned the labour market has stabilised. What's behind the sort of healthy setting in the jobs market?
Yeah, I mean, unemployment hasn't surged. Prices remain a little bit higher than the public and I think the government wants. But, unemployment, aside from some of these headline government job cuts, has been fairly healthy.
Right. You mentioned that the Fed is preparing themselves to cut rates again later in the year, but they also said they're not in any hurry to do so. What could encourage the Fed to either cut them or perhaps back off from that idea?
Yeah, if they were going to ramp up cuts, they would need to see the monthly inflation, either PCE or CPI, start to tick lower than expected. Also, increased business uncertainty across the board. We're seeing, the GDP Now tracker is, at least for now, showing a negative GDP for how deep we are in Q1. So that could also be another trigger to cut rates earlier. For rates to go higher or for the expectation to be pushed out further, inflation needs to be a lot hotter than expected.
So given mortgage rates are so high at the moment, is there any forecasting that might suggest those rates will come down? And what will it take for interest rates to come down? Are the days of seeing interest rates of 3.5 over?
Yeah, I mean, we need some kind of a disaster to get down to 3.5 in my view, but that doesn't mean things are terrible. The premium on the 10-year Treasury to the 30-year fixed rate mortgage is near historical highs. So if just that premium comes down, then rates will come down on the long end. It's just the premium on the long end of those mortgages is just near historical highs. And we believe that's because of the uncertainty in the environment.
And when we talk about uncertainty, there's a lot of fears around a recession with these very drastic policy changes coming from the Trump administration. Is that something that's on your mind too? Do you foresee a big change in the economy to the point that job losses will be en masse and that we could all be sitting in a recession again?
I don't see us in a recession at the moment, not with unemployment where it sits today. You would need to see unemployment probably tick up 0.75% for us to actually see a recession. We might get one negative quarter of GDP, which could scare the market. But, I don't think that we're in the middle of a recession that we just don't know about, and the Fed hasn't checked the box on that one yet.
I think there are a few questions swirling around Powell today around the 1970s when stagflation led to the devaluation of the US dollar. He said that he doesn't expect a replay of the 70s. Do you think that that was an alarmist take from the questioner who asked that?
Yeah, I do think it was an alarmist question. It's like similar to asking people if this is the next Lehman Brothers. I think it was a little alarmist. During the 70s, inflation was much higher for longer, and I don't believe we ever got down to the levels we're at today. So, our target's 2.2%, and we're a little close to 3. That doesn't seem terrible given the low level of unemployment. I don't think it would be worth it to crash the economy and increase unemployment dramatically to bring rates down to 2% on inflation.
But given the way that the Trump administration is rolling politically and it's forecast to, of course, we don't know what Donald Trump is going to do, but there is an indication of what he wants to do. What kind of, knock-on effect will that have across the labour market and the economy as a whole, say, in a year or two's time?
Yeah, I mean, I think this depends on what you believe, if tariffs are a negotiating tool or are going to be more of a way of life. And you hear both sides of that come out of different aspects of the administration. So, I'll be honest, that's going to be really hard to tell here. I don't think anyone is going to intentionally crash the US economy, though. So I think the wheels will stay on.
All right.
And we've seen that. Well, sorry, go ahead.
No, please finish your point.
No, I mean, we've seen that with the on again, off again tariffs, right? And I think that's the bigger issue. It's not whether there's going to be tariffs or not, it's the uncertainty around the implementation, or are they always going to whipsaw the market?